Good morning, everyone. Thank you for joining this month's market review and meeting. I must say it's very nice to be able to report a presentation like this after we've had such a strong run in the markets. I think central banks have hit the pause button in their rate hikes, which is quite a good thing for the markets. And then, of course, earnings have been strong again. So far for the Q2 earnings, they are ahead of expectations. So that's really good. And then recently the on-off talks between Iran and the US are turning a little bit positive. So the oil price has come down, and that is another tailwind for the markets. And also, I think one of the other reasons is that the retail investor euphoria that we've experienced in those Far Eastern AI markets, most notably Korea and Taiwan, that a lot of that euphoria seems to have been pared back. And if you look at margin trades, those have normalized. And in fact, most of the selling in Korea is retail investors rather than institutional investors. But it's most often than not the retail investors that create bubble conditions. So it's good that retail investor euphoria in Korea has ebbed away a little bit, creating a more solid foundation for future market moves. So that's the introduction. I'm going to refer to material from different analysts, economists, including MRB, Capital Economics, Bank Credit Analysts, and JP Morgan. The first segment, the longest one, is going to be about the economic and market outlook. I'm going to discuss a little bit central bank monetary policy, which is all important in terms of guiding interest rates and bond market yields. And then I'm going to close off a little bit on the AI outlook. And lastly, the geopolitics and the Iran conflict, if we've still got time. I think that's probably the least important. I know it's strange to say, but there's a comment that I'll come to later on, that unless the US or Russia use nuclear weapons, then really any conflict is second place to economic fundamentals. Anyway, let's get started. Starting off with the economic and market outlook from MB, say accommodative global monetary conditions and the solid uptrend in corporate earnings herald further upside in the stock bond ratio. It will take much higher developed market bond yields before the investment cycle ends. So certainly very positive there. They do caution, however, that the catalyst for an end to the investment cycle will be an overshoot in developed market bond yields and or developed market central banks shifting to restrictive policy settings due to sticky above target inflation. So those are the things that we are monitoring very closely. And then they warn that to this end, we would note that global bond yields did not decline much when oil prices recently tumbled. We view this as a confirmation that the underlying uptrend in bond yields is intact. So we should heed that warning. But then they turn more bullish again. Fed Chair and the bond zealots are banking on AI generating significant and lasting productivity gains and a return to re-environment. The Fed is likely to maintain policy in accommodative territory for the foreseeable future, which is pro-growth and supportive of even more asset price inflation. With regards to a broadening in earnings growth, while overall corporate earnings measures have been upward biased due to booming AI tech profits, excluding those tech profits, earnings are also rising, and the gains are broad-based geographically. So there's definitely a broadening in the earnings cycle. Then we turn to capital economics. The experience of the past few months suggests a global recession and major monetary tightening cycle may be less likely than many had previously assumed. But there's always a but commercial oil inventories have been depleted, so a tipping point in oil markets cannot be delayed indefinitely. And they note that the Eurozone and UK economies continue to grow steadily in the second quarter. The risk of second round effects causing inflation to become entrenched is low. So a positive outlook from capital economics as well. And now we're going to turn to bank credit analysts, also positive. They've been very surprised by the speed and amount by which the oil price has declined, has taken us by surprise. And in fact, they've called not far into the past for a significant downside potential in the oil price if the Middle East crisis is resolved. And that should ensure that inflation peaks and the US dollar and bond yields with it. The Fed is likely to replicate its one and done rate hikes of 1997. And then they're the ones that say, short of the US and Russia using nuclear weapons, geopolitics remains messy, but secondary to macro fundamentals, which of course are bullish. Where do we stand on macro fundamentals? Leverage across the developed world, particularly in the US, households and corporates remain shockingly unleveraged. So certainly that risk falls into the background. In terms of the bubble watch, a lot of media are talking about the bubbles in stock markets, and they say that the stock market is nowhere near as stretched between valuations and earnings as it was the last time a new technology dawned on mankind in the 1990s. So in other words, earnings have kept up with the increase in the composition and the weighting of the tech sector in that index. In terms of inflation, prices do remain above central bank targets, but we would caution investors not to get overly inflation obsessed. In terms of the inflation discussion, we mustn't exaggerate the threat. Oil prices have basically collapsed since their peak in April, and the market has learned that in the 21st century, the world has far more supply chain resilience than was previously imagined. Repeated supply chain shocks have proven this. In COVID, during the tariffs, in 2022, when Russia launched its invasion of Ukraine, and again in 2026, we have come out of supply chain shocks far more successfully than anyone imagined. And that's despite global political fragmentation. In fact, the argument is that it may well be because of that global political fragmentation that the global supply chains are so much more flexible. Colleague Juan Correa, co-head of BCA's portfolio construction strategy, remains a bull on AI, and one should listen, given that he has been right on AI being the main driver of the economic cycle since 2025. He says data center capacity continues to grow while the cloud backlog and expected utilization are increasing. In fact, current CapEx estimates may very well be wrong on the low side and are likely to reaccelerate. And then one last comment from bank credit analyst BCA. We continue to be constructive on the S&P 500 with a robust 8,100, despite some mild multiple compression. Risks stem mostly from the bond market and a wave of IPO activity, both with the potential to impact valuations, i.e. the multiple, more so than earnings growth itself. From JP Morgan, if the Iran conflict impact keeps getting priced out, as we suspect, then oil price, inflation rates, inflation expectations, bond yields, central bank rate projections, and eventually the US dollar could all continue reversing their up move. Now moving on to our next segment, central bank monetary policy. In July, we had central bank meetings from the ECB, Federal Reserve, and the Bank of England. They all kept their rates unchanged. And that is becoming the textbook monetary policy reaction to the current Middle East crisis. Policymakers in general are acknowledging the inflation risks, reiterating the need to guard against second-round effects on wages and prices, but they all left policy unchanged. In fact, second-round inflation effects so far have shown very little evidence of emerging. And then labor markets across the advanced economies are no longer as tight, certainly not as tight as they were in 2022, the last time we had an oil price shock. So the fact that labor markets are not as tight should limit the extent to which a rise in energy prices feeds into persistent domestic inflation. If tensions ease and oil prices drop back, then central banks can largely look through the inflation shock. At the moment, the futures markets are pointing to 50 bips of interest rate hikes in the US, in the Eurozone, and in the UK. Of course, if the oil price keeps dropping, then those futures markets may very well scale back those forecasts. What happened with Kevin Walsh's Fed meeting in July, as I mentioned already, they kept rates unchanged. And if the inflation reports continue to be less harmful than expected, in fact, the June US CPI data point was very helpful in that regard, then the Fed may well delay liftoff in rate hikes until December. In the FOMC meeting, Kevin Walsh added, and this is his quote, "We're going to deliver 2% inflation and not a whisper more." So there he's trying to burnish his hawkish credentials. But to achieve that, I'm looking at a broader set of inflation data than personal consumption expenditures inflation index. So in other words, he is potentially giving himself a bit of wriggle room from that point of view. And now turning to the last segment, the AI stock market boom, the second to last, the next segment, the AI stock boom. And this is from Capital Economics. Will the AI train get back on track once the dust has settled? Our working assumption is that it will do so. Our end 2026 forecast for the S&P 500 is 8250. So a nice 10% or so above current levels. The recent correction has mainly been driven by fear rather than evidence of things starting to go. Analysts' expectations for earnings per share in the big tech sectors combined have not yet shown signs of faltering. And that's translated into a drop in the forward price earnings multiples in AI and tech stocks, thereby potentially creating room for a sizable recovery if sentiment turns. So you'll remember that the forward PEs for the hyperscalers is back to 2015 levels. So a lot of value, in fact, emerging in that segment of the AI market. Bank credit analysts had a survey on the outlook for AI. So they surveyed their clients, predominantly institutional wealth management, asset management companies. And then they also surveyed the broader public. So their own clients, 71% of their own clients remain bullish on AI, due mainly to scarcity in compute. And then this is interesting. There was a broader public that was less bullish. Apparently their vote was almost 50-50, very close to the negative sector. And the reason for that was due to stretched valuations and also concerns over a rollover in free cash flow. So where did they survey? On LinkedIn and on X, so social media platforms. And this is what we've been picking up actually, is that most of the negativity is from retail investors, not from institutions. And I think that is very bullish in terms of the sustainability of the bull market. And the client's emphasis on compute scarcity echoes the bull case from bank credit analysts. Hyperscaler cloud backlogs have grown by roughly $750 billion in just the past 2 quarters, a sign that demand is still outpacing supply.
Hi, Nick. And I must say, it's all sounding very positive, which puts a smile on my face. So I think there's still gains to be made for clients this year. So let's kick off the local update for July. And in the usual fashion, we'll check in on some macro data. We'll touch on some performance of the JSE, as well as just some results of one of our portfolio companies. So on the macro front, the single biggest swing factor in July was without a doubt the oil price. Brent moved from around $72 a barrel at the start of the month to above 100 USD by the 24th of July. And that was driven by an escalating Middle East conflict, as you all know, before easing back to around $90 by month end. And as we've touched on a few times, this matters specifically in SA because we import the overwhelming majority of our fuel. So every dollar move in oil shows up at the pump pretty soon after. And from there, works its way into everything from taxi fares to the cost of moving goods around the country. That being said, I think it's important to note that CPI or inflation is in fact a lagging indicator. So as you can see on the graphs, the higher oil prices seen earlier in the year have been feeding into later months' inflation, with the June inflation print coming in at 5% year on year after we saw 4.5% print in May. That is a 2-year high, which is a fair bit above the Reserve Bank's 3% inflation target, which you can see by the blue line at the bottom there. Core inflation, which strips out food and fuel, ticked up to 4.1% year on year, and that's the number that tends to worry policymakers more. Reason being, a sharp rise would suggest price pressure is broadening rather than staying contained to fuel alone. The encouraging offset, though, is that food inflation actually continued to ease. That was down to just 1.4%. So far, this is very specifically a fuel and transport story for now, not necessarily a squeeze on every part of household budget for South Africans. And for investors, it looks like the path back to the 3% target isn't necessarily a fairy tale. I think it is possible, but it's just been pushed out a bit. So against this current macro backdrop, the Reserve Bank held the repo rate steady at 7% at their meeting on the 23rd of July. Although once again, it wasn't unanimous, with 4 members voting to hold, while 2 wanted another 25 basis point hike. And I think that split tells us that the committee continues to battle with how much weight to give a fuel price shock that may or may not persist. Their own forecasts see inflation staying above 4% until early next year, but growth expectations for SA GDP was actually nudged slightly upwards to 1.4% for 2026. So in other words, the SARB seems to be choosing patience over panic here. I'm not sure about you, but I would love to see lower interest rates. However, I also understand inflation needs to come down before the SARB can continue with the cutting cycle, even if that inflation is in fact supply driven. This will likely only take place towards the end of the year or early 2027. In other news, I do have a genuinely encouraging data point worth calling out, and I think it's worth touching. because good news on electricity hasn't really been highlighted in some time. But Eskom's energy availability factor, or the EAF, briefly crossed the 80% point in mid-July. That was the first time we've seen that level since 2017. And if sustained, it matters enormously for the medium-term growth outlook, given how much reliable power has constrained the domestic recovery over the past decade. The growth picture in other parts of our economy is a bit more mixed though. Manufacturing remains in contraction, mining output fell sharply in May, and business confidence did take a real knock in Q2. Let's move on to some market performance. Given all the above that I've just mentioned, you'd be forgiven if you expected to see a rough month for local equities. Instead, the ALSI, which you can see is the green line on that graph, finished July 1.2% higher, with the top 40 doing just a touch better. It wasn't a straight line though. The index dipped in early July on rand weakness, and then again mid-month as geopolitics flared up. However, it recovered towards month end as the geopolitical tension eased. That leaves the ALSI down 1.8% year to date on a total return basis as at the end of July. Industry-wise, leadership changed throughout the month as well. Gold miners led early in the month as the oil shock drove a flight to safe havens, but we saw that trade unwind sharply a few weeks into July as broader risk appetite returned globally. And from there, financials, which is marked in red on the graph, took over, benefiting from the Reserve Bank's decision to hold rates rather than hike, while resources ended up lagging later on, which is the blue line in the graph. Overall, I'd call it a healthy rotation as it points towards the market pricing in stability rather than chasing whichever commodity was moving for those final 2 weeks. Looking over the pond, the equities slightly outperformed the S&P 500 during July. That's a small win, but I do think it carries some weight. It shows domestic asset classes can hold their own even when global sentiment is a little bit choppy, but it's provided that the local policy backdrop does stay credible. The rand weakened through most of the month as oil spiked, briefly testing the 17 rand mark to the USD before clawing back some of the losses as the price of Brent crude dropped back down. Current rate to USD is 16 rand 39. Next up, we've got some updates on the portfolio, some holdings in our portfolio. So there hasn't been much action on the reporting side, but impressive half-year results have recently been released by Valterra Platinum. So H1 2026 revenue rose 93% to just under 82 billion rand as higher PGM prices and improved production drove a sharp earnings recovery. Adjusted EBITDA quadrupled to just over 33 billion rand. Headline earnings per share launched to 82 rand per share from less than 5 rand a year ago. And their balance sheet improved from a net debt position to more than 23 billion rand in net cash. Strong cash generation allowed the board to declare 57 rand per share dividend, which is equivalent to a 70% payout ratio. And while management left full year guidance unchanged, it did caution that unit costs are likely to come in at the upper end of their guided range due to the ongoing cost pressures. Elsewhere, we've been watching smaller developments at Pepkor. Management is progressing with the merger of its flash business with shop-to-shop fintech businesses, with the real possibility of an eventual separate listing. We think that could unlock value the market isn't currently giving the group credit for. So keep your eyes peeled on this one. In conclusion, I think if there's one thing to take from the last month, it's that SA assets continue to show real resilience against an external shock that could have in fact knocked them off course. One of our holdings delivered results that reminded us exactly why disciplined exposure to quality businesses through a commodity cycle can pay off when the cycle turns in your favor. Looking ahead, we're watching the PGM space closely alongside a handful of holdings we believe are trading at unwarranted discounts to their underlying value. But on the risk side, oil in the Middle East remain the swing factor for almost every domestic variable that matters. Foreign investors have been persistent net sellers of SA equities so far this year, and local elections will keep political headlines coming thick and fast, without a doubt. However, I think it's important to highlight that none of that changes our approach. The markets will always give you plenty of reasons to react to the headline of the day, but the businesses we hold are built to compound value over years rather than weeks, and this month's results are a good reminder of why that patience is worth having.